Three separate strategies are just three separate strategies. You could run an active trading account and a long-term investment portfolio and a speculative position in a cryptocurrency you believe in, and have all three of those things running at the same time without them constituting a system. They would be parallel activities. Each would rise or fall on its own merits. The cash you made in one would sit in that account undeployed to the others. The losses in one would have no relationship to the gains in another. They would not interact. They would not support each other. They would not accelerate each other. What makes the three-engine wealth system a system rather than a collection of parallel activities is the deliberate flow of capital between the engines and the way that flow creates a self-reinforcing loop that grows more powerful over time. The engines are not independent. They are interdependent by design. The output of the first engine becomes the fuel for the second. The returns of the second engine fund the third. And as each engine grows, it increases the capacity of the engines downstream. And we've spent the last 5 episodes introducing each engine individually, what it does, why it exists, and how it operates. And today we take a step back and look at the whole machine. We trace the capital flow from the moment that it enters the system to the moment it compounds into long horizon wealth. We examine why 3 different time horizons and 3 different risk profiles working together create a resilience that no single engine could provide alone. And we look at what the system looks like when one engine is under stress. Because understanding how the system absorbs shocks is as important as understanding how it performs when everything's going well. Before we trace the capital flow, I want to revisit the single most important conceptual point from episode 2, because everything that follows depends on it. Most investors think of their financial activities as a collection. They have accounts. They have positions. They review each one separately and make decisions about each one in isolation. The collection's performance is the sum of its parts. But a system thinks differently. In a system, the components have defined relationships. The output of one component is the input of another. The failure of one component triggers a compensatory response in another. And the performance of the whole is greater than what any individual part could produce, because the interactions between parts create something that the parts alone cannot. And that's what we're building. That is why the sequencing matters. And it's why understanding the connections between the engines is as important as understanding the engines themselves. Now let's talk about tracing the capital flow. Let's actually trace a dollar through the system. And we'll use the $1 million experiments specific numbers as a concrete example. And not because these are the only valid numbers, of course, but because these give us something real to follow. Your own implementation will have different figures depending on the approach you choose for each engine. In the $1 million experiment, $5,000 arrives each month for 12 months. That's $60,000 in total. The contribution follows a 2-phase structure. In months 1 through 6, $3,000 goes to the income engine and $2,000 to the growth engine, and no direct accumulation engine contribution yet. From months 7 through 12, though, the split changes a bit. $2,000 goes to the income engine, and $2,500 goes to the growth engine, and $500 directly to the accumulation engine. And after month 12, external contributions stop entirely. The system must sustain and grow itself from that point forward through its own internal capital flows. Your own contribution split might differ. The $1 million experiment split reflects deliberate choices that we made about building the income engine to scale quickly in the early months. The income engine receives its allocation and puts it to work immediately. In the $1 million experiment, the income engine starts with a $3,000 trading account and targets $249 per month. That's 8.3% monthly return on that starting capital. That target is specific to the instrument and approach that we've chosen for the $1 million experiment. Your income engine might target a different return, depending on your method. The principle, though, is the same. The income engine generates monthly cash flow from active market participation. In the $1 million experiment, all of the income engine's trading profit stays within the engine, building the account and scaling position size until the balance reaches an arbitrarily set threshold of $500,000. Before that point, the income engine is in pure growth mode, no outflows. But once it crosses $500,000, 50% of monthly trading profits begin flowing out as personal income. That's where the $20,000 a month, that's part of the $1 million experiment's target outcome. And any balance above the cap transfers to the growth engine. So in the $1 million experiment's early years, the income engine is not feeding the growth engine from trading profits. It's building its own scale. The growth engine's early fuel is its direct contribution allocation and its own returns. The growth engine takes its direct contribution allocation each month and compounds it through its chosen systematic approach, which in the $1 million experiment is the wheel strategy. Now, from the very first month, 10% of the growth engine's monthly returns flow over to the accumulation engine. This transfer starts immediately and runs throughout the life of the system. The growth engine's returns will have up months and down months, and that's just the nature of equity-based approaches. But what matters is the compounding trajectory over quarters and years, which the model expects to substantially outperform passive investing, while simultaneously seeding the accumulation engine from day one. As the growth engine balance grows and generates returns above the capital required to sustain its own compounding, a portion of those returns begins to flow into the accumulation engine. This is the second capital flow junction. Growth engine returns lead to accumulation engine positions. The accumulation engine uses that capital to build a portfolio, and this is a portfolio of thesis-driven, asymmetric positions in multi-year trends. Those positions are held for years. They're reviewed annually, and they're sized consistently regardless of conviction level. Now trace this forward 12 months. The income engine has been running and retaining all profits, building toward its $500,000 threshold. The growth engine has been compounding its contribution allocation and sending 10% of its monthly return to the accumulation engine from the start. The accumulation engine has received 12 months of those transfers and has some positions established. The whole system is larger than in month 1, each engine operating according to its defined role. At month 12, something important has happened. The system is no longer primarily dependent on the monthly salary contribution to grow. The income engine is now generating meaningful cash flow from its own operations. The growth engine is compounding a base that is now significantly larger than what the direct contributions alone would have produced. And the accumulation engine has positions in place that are accruing value or not, depending on how these theses are developing, independently of anything happening in the other two engines. The system has become partially self-funding, and that is the moment that the architecture really starts to matter. What makes the three-engine wealth system more than the sum of its parts is the self-reinforcing nature of the capital flow. As each engine performs, it increases the capacity of the engines downstream. And as the downstream engines grow, they send more capital back into the system's growth cycle. So here's how that loop operates. The income engine generates cash. That cash flows into the growth engine. The growth engine compounds it into a larger capital base. And a larger growth engine generates larger returns. Those larger returns fund larger accumulation engine positions. If those positions perform well, then those returns can flow back into the system, back into the income engine to increase trading scale, or into the growth engine to accelerate compounding, or even into new accumulation engine positions. The loop becomes self-reinforcing. Each cycle through the system leaves the engines larger and more capable than they were at the start of the cycle. This is the architecture behind the $1 million experiment. The $1 million experiment's thesis is that $60,000 deployed systematically over 12 months into this three-engine structure can grow to $1 million in cash and an ongoing $20,000 a month in income within 5 years. And that's an ambitious target for sure. But we believe it's an achievable one through disciplined execution of the system. The purpose of the $1 million experiment is to test that hypothesis in live markets with real capital reported transparently so that anyone watching can evaluate the evidence for themselves rather than taking our word for it. The mathematics that make this thesis plausible are grounded in the self-reinforcing nature of the loop. In year one, the system is primarily being fed by external capital. That's the monthly contributions. By year two, the income engine is generating meaningful cash flow that supplements those contributions. By year three, the growth engine is compounding a balance large enough that its returns are themselves a significant source of new capital. By years 4 and 5, the system is operating with significant momentum, not because any single month has produced spectacular results, but because 3 years of consistent execution across all three engines has built something that compounds powerfully on its own. Now, I want to be specific about what self-reinforcing does not mean. It does not mean that the system grows smoothly or predictably in every period. The growth engine will have periods of strong performance and periods of pressure, reflecting the nature of equity markets. The income engine will have good months and difficult months, reflecting the nature of active trading. The accumulation engine will have positions that are performing and positions that are not performing, often simultaneously. What self-reinforcing means is that the overall trajectory of the system, measured over years, not months, is upward and accelerating, because the capital base on which each engine operates is growing larger over time. In month one, the income engine starts with its $3,000 trading account, retaining all the profits. The growth engine begins compounding its $2,000 monthly contribution, sending 10% of its return to the accumulation engine. By month 12, the income engine account is materially larger. The growth engine has compounded 12 months of contributions and returns, and the accumulation engine has received 12 monthly transfers and has some positions in place. Month 13 begins with no external contributions. Each engine must now sustain and grow itself from its own internal flows. And that's the design. Build each engine to sufficiently scale during the contribution phase so the compounding continues under its own momentum thereafter. One of the most important structural features of the three-engine wealth system is that the three engines operate on fundamentally different time horizons and carry fundamentally different risk profiles. This is not an accident. This is a deliberate design choice that makes the system resilient in ways that a single engine approach could not be. The income engine operates on a monthly cycle. Its performance is measured month by month. It uses approaches that can be profitable in rising markets, falling markets, or sideways markets. And because the income engine's returns are generated by activity, not by holding a position and waiting for appreciation, this means that the income engine is the most time-sensitive of the three engines, the most operationally active, and the one that is least dependent on the direction of any particular market. The growth engine operates on a quarterly and annual horizon. Individual months matter less than the trend over quarters. A month where the growth engine's equity positions are under pressure does not indicate that the growth engine is failing. It indicates that equity markets are in a down period, which is normal and expected. The growth engine's performance is evaluated on whether its systematic approach is producing substantial outperformance of passive market returns over time, not on whether any given month was positive. The accumulation engine operates on a 3 to 10 year horizon. Individual years matter less than whether the multi-year theses are developing as expected. A year where accumulation engine positions are down significantly is not necessarily a sign that the thesis selection was poor. It may simply reflect that market volatility that is entirely normal for long horizon asymmetric positions. The accumulation engine's performance is evaluated at annual reviews against the thesis, not against the current price. These three time horizons mean that the system is never fully exposed to any single market condition at any single moment. When equity markets are in a sharp correction, the income engine may be generating its best returns of the year. Active trading strategies can be highly profitable in volatile, trending markets. When the income engine is going through a difficult period, markets are choppy, setups are unclear, monthly returns are below target, the growth engine is compounding its existing base regardless, and the accumulation engine is quietly holding positions that have nothing to do with short-term market noise. No single adverse condition simultaneously impairs all three engines. That is the resilience that this architecture provides. There's another dimension to the time horizon separation that is worth making explicit. It's the psychological dimension. One of the most common ways investors destroy long-term returns is by letting the performance of a short horizon activity contaminate their decision-making about a long horizon one. A bad month in the income engine is not a signal to reconsider the growth engine thesis. And a correction in the growth engine is not a signal to exit the accumulation engine positions. Each engine is evaluated on its own time horizon, against its own criteria, with its own decision framework. The system architecture is also a discipline architecture. It gives you a principled reason to keep each engine operating according to its own logic, even when one of the others is under pressure. Now let me walk through how the system absorbs shocks in each engine specifically. If the income engine goes through a difficult period, the growth engine continues operating on its own compounding momentum. During the early years of the $1 million experiment, while the income engine is building toward its $500,000 threshold, the two engines operate largely in parallel. The income engine is building scale, the growth engine is compounding its own base. A bad period in the income engine does not stop the growth engine. Later, once the threshold is crossed and the income engine begins transferring surplus to the growth engine, well then a shortfall will reduce that inflow. But the growth engine still compounds whatever capital it holds. If the growth engine goes through a down period, the system has ongoing capital to deploy at lower prices. During the contribution phase, the direct monthly allocation continues regardless of market conditions, buying quality assets at cheaper prices. In later years, once the income engine is transferring surplus capital to the growth engine, that inflow adds further buying power in corrections. A down market is a repricing event, and the system is designed to ensure that new capital keeps arriving into the growth engine regardless of where prices are. If the accumulation engine has positions that are significantly underwater, theses that have not yet played out or that have run into unexpected headwinds, the other two engines are unaffected, because the accumulation engine is sized so that its worst-case outcome does not impair the system. The income engine just keeps generating cash, and the growth engine keeps compounding. The accumulation engine manages its thesis portfolios according to the annual review process, making decisions based on the thesis status rather than price. A bad year for the accumulation engine is absorbed by a system that does not depend on the accumulation engine to function. This is the interdependence that makes the system protective rather than fragile. Three engines designed to compensate for each other's weaknesses, each providing something that the others cannot provide on their own. Now let me bring this together. The three-engine wealth system is not three separate strategies running in parallel. It's a single system with three interdependent components, each with a defined role, a defined time horizon, and a defined risk profile, and with deliberate capital flows connecting them in a sequence that creates compounding momentum over time. The income engine builds its account toward the threshold where it begins paying out personal income and transferring surplus to the growth engine. The growth engine compounds its contribution allocation and its own returns, sending 10% of those returns to the accumulation engine from the very first month. The accumulation engine builds its thesis-driven portfolio from that ongoing inflow. The engines work largely in parallel early on and become progressively more interdependent as each one reaches scale. The system is self-reinforcing. As each engine grows, it increases the capacity of the engines downstream. It's resilient. Three different time horizons and risk profiles means that no single adverse market condition simultaneously impairs all three engines. And it is designed to accelerate. The longer it runs with disciplined execution, the more powerful the compounding momentum becomes. In the next episode, we're going to address one of the most practical questions in the entire series. How much goes where? We're going to work through exactly how to size each engine based on your starting capital, the specific allocation rules, how to think about the split between the engines, and how sizing evolves as the system grows. This is where the framework becomes executable. We're also going to look at the $1 million experiment's specific sizing decisions and the reasoning behind them so that you have a concrete reference point for making your own decisions. The full 5-year plan for the $1 million experiment, including the projected capital trajectory for each engine, The monthly contribution schedule and the expected outcomes at each year-end milestone is available as a free download at theinvestingproject.com. The link is shown on the screen and it's in the video description. If you want to see the complete picture of what this system is designed to produce, that document is the place to start. Meanwhile, subscribe so you don't miss the next episode. And if you have questions about anything we've covered today, the capital flow, the time horizon separation, or how the shock absorption works in practice, just drop them into the comments. We read all of them. We'll be happy to see you there.